Net sales of $976 million, up 5% at constant currency. Basic EPS sitting at 54 cents. Adjusted EBIT hitting $152 million. And management just aggressively raised their full-year 2026 guidance across all key metrics.
I mean, those are just incredibly strong headline numbers for Garrett Motion's Q2 print.
Right, but if you're a retail investor, just reading those headlines on your feed, it's not enough.
No, definitely not.
The mission of today's deep dive is to strip away the corporate spin from Garrett's earnings presentation and their 10Q filing. We are here to analyze the underlying mechanics of exactly how they built this quarter.
Yeah, we have to cut through the noise because what's fascinating here is, well, you look past that solid top-line revenue growth, and the real story is entirely hidden in the product mix.
Right.
It's about how they're navigating some incredibly stiff foreign exchange headwinds. It's just a masterclass in pulling the right operational levers.
Oh, okay, let's unpack this. Starting with that $976 million revenue print. We need to look under the hood and see where that growth actually came from.
Yeah, let's break down the verticals.
So gasoline is still their bread and butter, right? Making up 43% of total sales.
Yep, the biggest chunk.
Then diesel sitting at 24%, commercial vehicles and industrial at 19%, and the aftermarket segment is pulling up the rear at 12%.
And the momentum within those specific segments tells a fascinating story.
How so?
Well, that massive gasoline segment, it saw significant volume growth driven by new launches in Europe, India, and South America.
Okay.
But the diesel expansion, I mean, it wasn't coming from standard passenger cars. That growth was entirely driven by light commercial vehicles and pickup trucks globally.
Wait, I have to stop you right there. We have to address a glaring contradiction in all this.
Okay, lay it on me.
If you dig into the fine print of their 10Q guidance assumptions, management explicitly says they expect a 19% EV penetration rate in 2026.
Right, nearly 1 in 5 vehicles.
Exactly. 1 in 5 new vehicles hitting the road is fully electric. Completely lacks an internal combustion engine, so it doesn't need a turbocharger.
No turbos on an EV, yeah.
Right. So if a fifth of your total addressable market is just vanishing into electrification, how on earth is Garrett's legacy gasoline and diesel business still grinding out volume growth?
It's a great question, and honestly, that tension is the central thesis for any legacy auto supplier right now.
It just doesn't seem to add up.
Well, the answer comes down to the mechanics of what we call share of demand.
Okay, explain that.
So management actually expects the broader light vehicle industry production to be down for the year, somewhere between 2 and 4%.
So the pie is shrinking.
The pie itself is structurally shrinking, yes.
Yeah.
But Garrett is outperforming that broader industry decline by just taking a much larger slice of that slightly smaller pie.
Oh, I see, because competitors they're seeing the writing on the wall, right?
Exactly. Competitors are pulling back their R&D dollars from internal combustion engines to fund their own, very costly EV transitions.
They're essentially starving their legacy business to feed the future.
Right. But automakers still need highly advanced turbochargers today. For the millions of gasoline cars, they are still rolling off the assembly line right now.
Especially to meet those super strict global emission standards.
Precisely. And Garrett is stepping right into that void. They're gaining share of demand and securing massive new programs, including this really large light vehicle program in North America.
Wow, okay. So it's one thing to grow market share and be the last major player standing, but are they buying that revenue?
You mean with discounts?
Yeah, are they discounting just to keep the assembly lines running, or is that actually falling to the bottom line?
That is the million-dollar question.
Right, so we have to transition from the revenue mix directly to profitability and margin expansion.
Yeah.
Because gross profit margins expanded to 21.7%.
Up from 19.8% in Q2 2025, yeah?
And their adjusted EBIT margin expanded 200 basis points to 15.6%.
Which is just a massive expansion in the auto supplier space. I mean, margins there are notoriously razor thin.
Yeah, they really are.
And it wasn't just driven by, raw volume leverage. It was driven by that favorable product mix we just talked about.
The commercial vehicles, industrial, and aftermarket growth.
Exactly. Those are traditionally much higher margin businesses compared to your standard passenger car contracts.
But, this margin expansion wasn't a free ride.
No, absolutely not.
I mean, the way I look at it, it's like they were swimming upstream with weights forward.
Swimming upstream with weights forward? I like that.
Seriously. Because they faced an $8 million headwind just from commodity, transportation, and energy inflation.
Everything costs more right now.
Right. And on top of that, they absorbed 80 basis points of margin dilution strictly from foreign exchange.
Yeah, the FX impact was brutal.
Specifically, they were fighting a stronger U.S. dollar to Chinese yuan and a devaluation of the euro against the dollar.
Which is it's essentially an invisible tax.
So how did they break through that? How did they swim upstream with all that extra weight?
Well, let's break down the mechanics because they offset those costs in two main ways. First, they executed $24 million in sheer productivity improvements.
Wait, 24 million.
Yeah, $24 million. And keep in mind, that is net of labor inflation and repositioning costs.
Oh, wow. So they paid their workers more and still squeezed out 24 million in operational savings on the factory floor.
Exactly. Trimming overhead, optimizing supply chains. But they didn't stop there. The second way they offset costs was by benefiting from $16 million in lower import tariffs and pricing pass-throughs.
Okay, pricing pass-throughs. That is the holy grail for an auto supplier.
It really is. It means they successfully went to their OEM customers and negotiated price hikes to cover their inflation.
And you only get to do that if your technology is absolutely mission critical. Automakers clearly can't meet emissions standards without Garrett's tech, so they just have to absorb the price hike.
Exactly. And that pricing power and factory execution, it translates directly into cash.
Which brings us to capital allocation. Because generating $152 million in adjusted EBIT and $122 million in adjusted free cash flow is great.
It's fantastic.
But investors want to know what management is doing with the cash. We have to look at how they are future-proofing the business.
Right. Sitting on cash while the internal combustion market declines is it's not a strategy.
No, it's not. So looking at capital return first, they repurchased $28 million of stock in Q2.
Leaving them with about $135 million remaining on the authorization, yeah.
And they declared an 8-cent quarterly dividend. But the technology investments, that is where the story completely shifts.
Yeah, this is the pivot.
They noted the pre-development of a commercial vehicle e-powertrain with a Japanese truck maker.
Huge deal.
And an agreement with Ingersoll Rand for centrifugal air compressors, targeting 2027 production.
Right.
And a major award for the Garrett Meg, used in gensets for data centers.
Yeah, the data center play.
Here's where it gets really interesting, because I have to push back here.
Go for it.
The keyword data center is everywhere right now. Every single company is slapping AI and data centers on their earnings transcripts.
Just to get a valuation bump, yeah, we see it all the time.
Right. So is management just using trendy buzzwords here, or is there a real structural strategic pivot happening away from traditional auto parts?
If we connect this to the bigger picture, it is absolutely a real strategic pivot. It's not just a buzzword.
Okay, walk me through it. Because car parts to data centers is a massive leap.
It sounds like a leap, but Garrett is leveraging its core competency. Their expertise is in centrifugal compressor and turbo technology.
The physics of moving air really fast.
Exactly. And they are applying that incredibly complex science to high-growth, non-auto sectors, like industrial air compression and data center power generation.
So how does a turbo fit into a data center?
Well, data centers need massive backup generators, gensets, to ensure zero downtime. And those gensets require highly advanced air management to fire up instantly and efficiently.
Ah, so it's a classic cash cow strategy.
That's exactly what it is.
They are funding their future tech, or these data center and industrial applications. Using all the massive legacy auto profits, they're still grinding out today.
Exactly. But, every bullish earnings call has a flip side hiding in the SEC filings.
Right. We have to shift from management's upbeat tone and do our duty as analysts. We have to read the risk factors and contingencies in the 10Q.
The fine print always has something.
Always. And there's one specific item that stood out. The Brazilian tax matter.
Oh, yeah, the tax credit issue.
Right. So Brazilian tax authorities issued an infraction against Garrett regarding the use of certain tax credits between 2017 and 2020.
Yeah.
And the estimated potential loss here is roughly $34 million.
Which isn't pocket change?
No. And management even notes that adverse outcomes could exceed those accrued amounts and be material to their cash flows.
Right. I think we need a grounded take on this, though.
How should an investor view that $34 million contingency?
Well, the underlying business operations are incredibly strong, right? We saw that in the cash flow and the margin expansion.
Absolutely.
But these geopolitical and regional regulatory issues, like localized tax disputes, these are the silent variables.
The things that don't show up in the top-line revenue beat.
Exactly. Just like their foreign exchange assumptions. Management assumed a euro to dollar exchange rate of 1.16 for the year.
And if that fluctuates?
If it fluctuates, it can quietly eat into that pristine $385 million to $475 million free cash flow guidance. It's just the reality of operating globally.
Yeah, that's a great point. You have to build in a margin of safety for those regional macro variables.
Always.
So to quickly recap the thesis for you.
Yeah.
Garrett Motion delivered a really clean quarter.
Very clean.
They beat back inflation and severe FX headwinds with sheer productivity and a very favorable mix.
Oh.
And they're quietly positioning their core tech for data centers and commercial EVs.
So what does this all mean for the listener? I'd leave you with this provocative thought.
Lay it on us.
If Garrett successfully executes this industrial and e-powertrain pivot, and they do it entirely using cash generated from a supposedly declining internal combustion market,
Yeah.
at what point does Wall Street have to stop pricing them as a legacy auto parts supplier and start valuing them as a premium industrial technology transition play?
Oh, that is the billion-dollar multiple expansion question right there.
It really is. It changes the entire valuation framework.
Well, that's all the time we have today. If you want to keep cutting through the noise and get the real mechanics behind the numbers, make sure to follow the show for our daily, no-nonsense earnings coverage. We will see you next time.